Welcome to the Explainer. So, you've got some money to invest. The first question everyone asks is, what stock should I buy? But today, we're going to talk about a much more important question. How should you actually structure your investments for long-term success? This is all about building a solid foundation, not just chasing a hot tip.
Here's how we're going to break it all down. First, we'll totally reframe how you think about investing. Then, we'll build out this really powerful three-pot framework that honestly simplifies everything. And finally, I'm going to show you two super common traps you absolutely need to avoid. Okay, let's dive in.
All right, before you even think about where to put a single dollar, let's talk about the real price of admission to the world of investing. And trust me, it's probably not what you think it is.
I know, it sounds completely crazy, right? But the source material makes such a powerful point here. Think of it this way. Small losses when you're young and don't have much capital, that's like paying tuition. Those losses teach you invaluable lessons that help you avoid absolutely catastrophic losses when you're older and have a lot more to lose. You're basically paying for your education when the price is still low.
You know, the funny thing is, the book knowledge isn't even the hardest part. You could probably learn all the theory you need in about 200 hours. I mean, that's less time than you might spend studying for a big exam in college. The concepts themselves, they're not rocket science. But the real teacher, the one you just can't get from a book, is time spent in the market. To truly get a feel for the emotional roller coaster of it all, you need to experience at least one full cycle: the boom, the bust, and then the recovery. This is exactly why starting early, even with a tiny amount, is so incredibly crucial. You're buying yourself time and experience.
So, okay, if the first step isn't trying to pick a winner, then what is it? Well, it's about asking a fundamentally better question, one that completely shifts your perspective. Most beginners are completely stuck on the left side of this slide, just agonizing over which individual stock to buy. But you know what? Experienced investors, they start on the right. They know that the structure of their portfolio is way more important than any single investment inside it. That shift in thinking, that's the secret to building a financial house that can actually withstand a storm. This whole idea is called asset allocation. It's the big strategic decision about how much of your money goes into the major categories, like stocks or bonds. And why does this matter so much? Well, because assets in the same category, they tend to move together. When stocks go up, most stocks go up. The truly big decision isn't which specific stock to buy, but how much to have in stocks in the first place. For most of us, these right here are the main buckets we can choose from. Each one has its own personality, its own risk and reward. Deciding the mix of these, your asset allocation, is, and I'm not exaggerating, probably the single most important investment decision you will ever make. Okay, let's move on to a really popular model for thinking about all this. And then we're going to see how we can make it even more powerful, just by looking a little bit deeper. A really common approach is this 4 pots method. It divides your money based on its purpose. You've got your daily cash, short-term savings, long-term growth, and then protection. It's a decent start for sure, because it gets you thinking about different goals. But it kind of hides a more fundamental truth about what your money's actually doing. So here's the crucial point. And if you remember one thing, make it this. Funds, trusts, and so many other products, they aren't assets themselves. They're just containers. They're wrappers. What truly matters is what's inside that container, because that's what's going to determine your risk and your return. This is what we call the underlying asset. It's the thing that's actually doing the work, the thing making you money, the bond that pays interest, the company stock that's generating profits, the real estate that's collecting rent. You should always be asking, what is the underlying asset here? Now, check this out, because this is where it all clicks. When we start looking at the underlying asset, those first 2 pots from the 4-pot model, your spending money and your stable savings, they're actually the same thing. At their core, they are both built on low-risk debt, like government bonds, so we can combine them. And this gives us a much clearer, more powerful 3-pot model based on what the money is actually invested in. So let's really dig into this refined 3-pot strategy. It's organized not by what your goals are, but by how your money is actually working for you. Your money now has 3 very distinct jobs. Pot 1 is your defense. It's built on safe debt where the main goal is just not to lose. Pot 2 is your offense, built on equity where you take smart risks for long-term growth. And Pot 3 is your protection, pure insurance, which isn't an investment at all, it's a shield. Mixing these 3 up, that's where most investors get into really serious trouble. And this brings us to one of the most valuable insights from our source material. Not all products are what they seem on the label. Let's see how this builds on our three-pot idea.
For your safety pot, you have to be so careful. A lot of products that are called bond funds are actually legally allowed to hold a pretty big chunk of stocks, sometimes up to 35%, just to boost their advertised returns. So you think you're playing defense, but you're actually taking on stock market risk you never signed up for. And that completely defeats the purpose of your safety pot.
The author's point is just simple and powerful. Keep your pots separate. Let your defensive assets play defense, and let your offensive assets play offense. Don't buy a product for your safety pot that's secretly trying to play offense on the side. And guess what? The exact same problem exists with insurance. Real insurance is for your protection pot. It's a shield, plain and simple. But so many products out there are actually just long-term savings accounts in disguise. They have high premiums and fancy features like dividends, but what they're really doing is locking up your money for decades at very low returns. They benefit the insurance company way more than they benefit you. And this quote just brilliantly illustrates the trade-off. Whenever you hear financial experts talk about how these products are great for the company because of their low cost of capital, just translate that in your head. Their low cost is your low return. That profit is coming directly from the low returns they are paying out to you. So here's your takeaway. Go back to your own finances and apply this framework. For every single product you own, ask these three questions. Is my safety pot truly safe? Is my growth pot actually invested for the long term? And is my protection a pure shield, or is it just a bad savings account in disguise? And that's the real question to leave you with. Take a hard look at your portfolio. Are your defense, offense, and protection assets clearly defined and separated? Or are they all kind of dangerously mixed up? Because I promise you, taking the time to untangle them might just be the most valuable investment you ever make.